Hello, welcome listeners and market participants to KBRA's European Credit Podcast, Conversations in European Credit. I am Gordon Kerr, Head of European Research at KBRA, and today I am joined by Asia Drobnik from our Financial Institutions Ratings team.
Thank you for having me back on today, Gordon.
Always a pleasure, Asia. Today, we will be covering an interesting topic, the European banking sector and its development as we head into what is referred to as the Basel Endgame. This topic is not only related to the banking sector, but also to the broader financing markets. The report can be found on kbra.com, along with other notable financials market publications, such as our popular annual look at the UK building societies. Let's look a little deeper. What sparked this report is something that has changed rapidly in the last several quarters in Europe. The focus is on something called targeted long-term refinancing operations, or TLTROs. Over the past 15 years, the European Central Bank has supported the banking sector with what are referred to as special liquidity operations. These long-term refinancing operations ballooned to reach a high of over 2 trillion in October 2021. Across banks and within the Eurozone. However, recently and rather rapidly, these TLTROs have been paid down to lows that have not been seen in a very long time. In this episode, Asia and I will look into this topic and the broader European banking picture in greater detail. Asia, first, let's start with giving everyone a little bit more detail on the significance of TLTROs.
Yes, I think most European market participants will find this interesting. The long-term refinancing operations are a normal part of a central bank operating processes. Banks borrow from this facility when they are in need of liquidity. They pledge assets to central bank and receive cash back with a valuation haircut, of course. Historically, it was considered a facility for banks in a difficult position and utilized as a short-term, 90-day last resort. This stigma disappeared during the GFC, the European sovereign debt crisis, and the pandemic. In the midst of this crisis, the ECB also introduced these special TLTROs you mentioned to support lending to the real economy and lift inflation. By offering these special refinancing operations, the ECB made use of them as a form of QE. The ECB would offer banks liquidity under the condition they would continue to actively lend to support the real economy. The first series of TLTROs were announced in June 2014, the second one in March 2016, and the third one in March 2019. However, the use of these facilities is disappearing rapidly.
Yes, they have disappeared rapidly. The use of long-term refinancing operations has now fallen to a level last seen in April 2005. This will soon drop further to return to negligible levels given the further maturities in September and December 2024 for the remaining TLTROs. During the GFC, the use of these long-term refinancing operations increased to a high of just over 700 billion in June 2010 from 120 billion in January 2007. And then, as I mentioned at the outset, they reached a final peak of over 2 trillion as a result of the COVID pandemic.
Yes, following the rise in the GFC, the European sovereign crisis further increased the banking sector's use of the facility to reach a high of over 1 trillion euro in April 2012. After this period, improvements in the banking sector and financial markets resulted in repayments of these facilities down to 375 billion euro in March 2015. The outstanding balance never fell below this number and increased again to over 600 billion euro just prior to the pandemic. The ECB then opened the taps for further use of refinancing operations, which banks utilize up to the total you mentioned of 2.2 trillion euro in October 2021. However, after December 2022, the facilities began to mature, and banks that didn't need the facility to begin with repaid early. The result has been a rapid paydown of a facility that had been in place and used extensively for over 15 years. Assuming banks will not need the liquidity facilities in the near term, the remaining TLTRO balances, which will have maturities in September and December of this year, will be repaid. After this, the market will return to just the traditional refinancing operations, and at the moment, even this will be with a balance below those seen prior to the GFC.
These facilities are traditionally used for liquidity purposes. If they are likely to reach such a low level, it would suggest that the banking sector has a great deal of liquidity at the moment, no?
Yes. Supporting liquidity for the banking sector is the level of liquidity coverage ratios, or LCRs, at EU banks. Average liquidity coverage has improved across the banking sector since 2016, when the European Banking Authority began tracking levels in the market. Average LCRs in the EU were 140% in the third quarter of 2016 and have since increased to 161% as of the first quarter of 2024. LCRs did climb as high as 175% during the pandemic and experienced another uplift during the height of TLTRO usage at end 2021. However, even with a marginal decrease from their peak, they remain at comfortable levels. Country-level LCRs are wide-ranging, with nations such as Portugal holding much higher liquidity than German, Dutch, or French banks. Portuguese banks have average LCR of 247%, Italy and Spain of 171%. At the lower end are Germany and the Netherlands with just under 150%, all of which are as of first quarter of this year. We will see an update for second quarter in September, but we do not expect any major changes to these average levels of coverage.
Thanks, Asia. This all points to a rather healthy banking sector, at least from a liquidity perspective. But what about in terms of the banking books?
Well, the banking sector in Europe has been making steady progress since some of the performance issues during the European sovereign debt crisis.
Yes, there were banks in a number of regions that had large books of bad loans. In the wake of the GFC and the Eurozone sovereign debt crisis, there were several banks in regions such as Greece, Ireland, Italy, and Portugal that developed large volumes of non-performing debt held on bank balance sheets, a number of which either made use of sovereign support or the use of securitization markets to help clean up their balance sheets.
Well, those banks have all now managed to reduce the non-performing loan book balances across the board. Since the elevated levels in 2014 to 2016, non-performing exposures, or NPEs, have declined as a percentage of bank lending to 1.6% across the EU, after reaching as high as 5.5% in fourth quarter of 2014. Bank NPE levels from Greece, Spain, and Portugal remain on the higher end of the averages, between 2 and 3%. However, these are significantly below the heights experienced during the European sovereign debt crisis, with previous peaks of 41% in Greece and 17% in both Portugal and Ireland. Spanish bank NPEs dropped to 2.5% in first quarter of 2024, from 7% in fourth quarter of 2014. Germany and Netherlands kept their NPE ratios below 4% in 2014, and both currently have the lowest averages, with 1.2%, despite a recent increase from the low of less than 1% in Germany in 2022. French banks' NPEs are also below 2%.
Okay, now that we know that European banks appear to be in a healthy position in terms of liquidity and loan book performance, the focus now for banks is all on regulations. We have been through extensive regulatory change since the financial crisis, but we are now approaching the last of these regulation changes, or what the press has now begun calling the Basel Endgame, even though, as we know, Asha, banking regulatory change never really has an end.
Yes, the tinkering will likely never cease. However, at last, the major changes developed in the wake of the GFC are now coming to a head. These banking regulations have been implemented in stages, helping to improve bank balance sheet, protection, and stability. Although regulators around the world are considering changes to the final implementations, most banks are continuing to raise capital or optimize their risk-weighted assets to prepare for these regulations.
Yeah, we've seen rapid growth in the use of synthetic risk transfer securities in the form of securitizations in Europe over the last several years. These have been an effective capital raising tool that, even though is a private market, KBRA has been providing ratings on some of these facilities. However, this is just one tool for bank CFOs for capital. How much further do banks need to go to increase their capital ratios?
The EU-based banks are comfortably positioned with their CET1 ratios averaging 16%, which is up from 11.5% in fourth quarter of 2014. Irish banks are at the high end of capital levels with over 19% CET1 ratios calculated according to the expected final Basel rules. Spanish banks are on the lower end with an average of under 13%. Most major European economies have CET1 ratios between 15.5% in the Netherlands and 17% in Portugal. Banks across all economies will be continuing to build up these ratios as we head into the end of the year and near the implementation of the Basel rules. However, we find that all of the progress so far has been very positive, with the banking sector focused on capital.
Banking regulations are intensive and have been slow to develop and implement. But from what we have discussed today and what you can find in the report, it appears that the banking sector in Europe is in a very healthy position relative to historical performance.
Yes, as the major Basel regulatory changes near their final stages, banks in the EU are in a much better position than they have been in a long time. Banks have adjusted to the new regulatory norms with liquidity improved, balance sheets in a strong position, and a robust levels of capital.
So what do we expect to see out of the banking sector then in the near term?
Well, there will continue to be a migration to managing capital most efficiently. This has been seen in the development of a synthetic securitization market in Europe to share risk with investors and increase capital. Further, banks have been returning to capital markets with the issuance of various instruments, including subordinated debt contracts, such as additional Tier 1 bonds, as well as via securitization and cover bonds for funding.
Thank you very much, Asia. That was a very interesting discussion.
Thank you, Gordon. I hope your listeners find that interesting. For me, I'm glad to see that what has felt like a slow process finally developed into what should be a robust and healthy banking environment.
Thank you very much, Asia. As you have heard from us today, capital is the focus for banks to reach the Basel endgame targets via the use of synthetic securitization and other capital funding methods. However, bank funding is also changing with the return of traditional securitization and other capital markets instruments used by banks to help fund their day-to-day operations. To date, as you have heard in our previous forecast, the securitization market has certainly been robust this year. Further, bank use of other capital market instruments has also been strong. As Asia has outlined in our call, they are now in a robust position and should help them to weather whatever challenges may lie ahead. That's it from us today. As always, we hope these conversations in credit help to illuminate the many trends taking shape across the markets. For more in-depth coverage of the themes discussed today, or to learn more about our unique approach to credit, sign up to the KBRA website to read all our research. If you have a topic idea or a comment you'd like to share, please reach out to me or Asha on the topics associated with today's episode. Be sure to rate, share, like, and subscribe to this podcast so you can be notified when new content is available. Invite your colleagues as well. We'd love to count you all as informed listeners. This is Gordon Kerr thanking you for being part of the conversation. Take care, everyone.